Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. August 14th, just after the close. Equity market had a bit of a churn to it this week in the indexes. S&P, let's call it up 0.5 point. Dow a little better. When we look under the hood, though, we do see that continued bid coming into the heavies, the industrials, the transports. Industrials up 2.5–3% this week, so outperforming the broad indexes. We've seen that now for 3, 4, 5 weeks. Just a slow reallocation out of some of the hotter sectors, such as tech, medical devices, which have certainly not fallen apart, but just churned, backed and filled, very healthy on that end. We'll see where demand comes. But very interesting to see the heavies trade so well, also in conjunction with rising interest rates. John will be on later on a video, give some thoughts, some ideas on what we're seeing in both the Treasury market and in some of the analytics the bond team looks at from an inflation standpoint, healthy inflation. So in terms of what we're doing on the equity side, very quiet week trading. We have some targets a little bit below where we're trading, and they happen to be in some of the areas that have lagged. For clients in our strategies, you've noticed over the last 4, 6, 7, 8 weeks, a couple of the purchases have been industrials, basic materials, banks, both in the indexes and in some individual names. Important to try to barbell that growth allocation in case growth stalls here and the cyclicality of a stronger economy takes over. So let's see. Have a great weekend. Look for John's video, and we'll see you next week.
Hi, it's John Mousseau. I am the President and CEO of Cumberland Advisors. It is Friday afternoon on August 14th. Yields higher this week. Saw the 10-year U.S. Treasury bond migrate up from essentially 0.52 to 0.72, rise of 20 basis points. Saw the 30-year bond effectively go from, call it 124 to 142, 18 basis points. Long tax-free high-grade bonds, less than half of that. You're now in a world where long tax-free bonds on the AAA scale are less than Treasury bonds. So the world has gotten back to normal yet again. It's taken quite a long time to get there. Some of the numbers this week support higher yields. The world is getting less bad, if you can use that as a phrase. We looked at jobless claims, still bad, but crept under 1 million for new claims. So the world is less bad. Inflation, higher. Trailing 12-month CPI, core inflation, up from 1.2 to 1.6. What does that mean? That means that we're kind of off the mat when you think about all the government stimulus that's out there. More stimulus to come, although Congress hasn't arrived on a package yet. We at Cumberland think they will at some point. Eventually, some of that fiscal stimulus becomes inflationary. You look at the monetary stimulus that's out there. That has increased the money supply, which it hasn't done in the past. Money supply has skyrocketed. Usually that results eventually in a higher velocity of money and some inflation. Again, not today, not tomorrow, but down the road, the signs somewhat point to higher inflation. Overall, the yields are low. Inflation is climbing somewhat. At Cumberland, what are we doing? We're starting to get a little more defensive. So we're taking some chips off the table. We're bringing some maturities a little closer to shore. We're taking some bonds that we bought in the middle of March during the worst part of the pandemic from an investment standpoint and taking profits. In some cases, they're fairly substantial profits. We're not afraid to play defense for a while. And that's kind of where we're leaning right now. We're not going there all at once. The way we kind of move portfolios around at Cumberland, you think about them as ships in a lock on a canal. Kind of move them all into one lock, lower the water level, move them all to another lock. We're kind of in that mode. So next week, we're going to look for hopefully some continued good numbers out there and we'll report back next Friday. Hope everybody has a nice weekend. Thanks a lot.